Well, it's a very basic question. I think economists and people in finance have been brought up or trained to think that that is the right thing, that profit maximization is the right thing. And the usual argument is that companies should behave on behalf of their owners, the shareholders, and that's what the shareholders want. I agree with the first part, that companies should act on behalf of shareholders because that's the way most companies are set up. The shareholders have the votes. But I think it's incorrect to say that shareholders always want the companies they own to make as much money as possible. Why is that? Well, first let me say it would be true. They would want profit maximization if the government regulated perfectly and controlled externalities perfectly. But unfortunately, we don't live in such a world. There are many government failures, not least because, let's take the case of climate change, to have really effective regulation, and most economists think that carbon taxes is the way to go on that, you would need carbon taxes throughout the world. So you would need not just one government, but many governments to coordinate on carbon taxes, and that seems extremely difficult to do. So in a situation where the government isn't doing a perfect job, then it turns out that the shareholders of companies may want the companies to sometimes pay attention to externalities. Let me give a few examples. So one example would be that between, I think about 1964 and 1990, Texaco was operating in Ecuador, and through its exploration of oil fields, it was creating a lot of pollution in Ecuador, which ended up causing a huge amount of damage and illness and death to people living in Ecuador. And that's something, there wasn't regulation against that. Texaco, which was eventually acquired by Chevron, as a US-based company, there weren't laws in Ecuador saying you couldn't do that. So this could well have been a profit-maximizing decision. But the question is, if you'd asked the Texaco shareholders at the time, they were never asked, but suppose they had been asked, do you like this? Do you approve of this? Yes, you get bigger dividends from this, but there's all that illness and death in Ecuador. Do you like that trade-off? They might have said no. I would like to think they would have said no. So that's an example one example of how profit maximization may not represent the interests of shareholders. To take another example, let's take an oil company like Exxon, that over the years has sponsored questionable scientific studies that argue that climate change isn't a big problem after all. They used to do this, and they knew very well that this was sort of very questionable science, but it suited their business purpose. And a second thing they have done is to lobby against climate regulation. I believe they're still doing that. I don't think they're doing the first thing, the fake science anymore, but I think they are doing the second thing. Well, both these things may be good for Exxon's bottom line, for its profit, and in fact even for long-run shareholder value. If you just look at the value of Exxon, then if you can convince people that climate change isn't a problem, if you can prevent climate regulation, that could be very good for long-term profitability of Exxon. But let's ask the question. Let's go to the Exxon shareholders. Would they approve of this? Is this good for them? It could be bad for them for three reasons. First, Exxon shareholders typically will hold shares in other companies, and Exxon's climate change could negatively affect the profits of the other companies they own. That's one reason. The second reason is that the shareholders of Exxon, who are, I'm not talking here about the institutions, but the people behind the institutions, the retail investors, they may not want to live in a hotter world. They may be wealthier, but what good is that if life is unpleasant? They may not want their children or grandchildren to live in a hotter world. they may also be other-centered in the way that I would hope the Texaco shareholders would have been with respect to people living in Ecuador. That is, they may be concerned about other people unrelated to them living in a harder world. For all those reasons, they may be against these activities of Exxon. And so they might be willing, if they had the choice, they would, I'd like to think they would say to Exxon, don't do this, even though it's going to reduce your profitability.
So capitalism has brought a lot of prosperity throughout the world, but in recent years has been dominated by large companies that bend the rules of the game in their own countries and in other countries to the detriment of the working of the system. So I think we should enable companies to be more accountable. And the key element for this accountability is to have a tribunus, a representative of shareholders at the board meeting that forces in the open a debate and a vote on the issue which has large externality vis-à-vis the rest of society. And so all too often companies take advantage of their information to hide. For example, tobacco companies knew very early on the damage of tobacco, and for many, many years they sold misinformation to the public, killing hundreds of thousands of people. If that information were forced in the open earlier, would have saved many lives.
Companies need to recognize why they exist, why they created, their reason for being, namely their purpose. And their purpose, of course, involves making money for their shareholders, because if they don't do that, they don't have the resources with which to fund their activities, and they cannot incentivize people to work for them. But they also have to recognize how that purpose of creating money for their shareholders is actually arrived at, how they do that. They need to recognize that they do that through solving problems for others, and that their purpose is to do that in a profitable fashion where they're not profiting from creating detriments for others. So the lesson that's coming out, I believe, from this conference is that profit is central, but profit has to be derivative of solving problems, not creating problems.
Well, when you say firm, it's going to have to be specific. Are we talking about the shareholders kind of taking positions, or are we talking about the CEOs, the top management of the firms taking position? I think it is totally fine if shareholders feel like they want to take a position on something, understanding the consequences of taking that position for whatever earnings the firm is going to make. If that's the shareholders' decision, it's totally fine. What I'm worried about is cases where, kind of CEOs use the position of power, very much like a standard kind of, agency problem, and use the position of power inside of the firm to say things that are political, but are really just a reflection of the CEO preferences rather than the preferences of the owner of the firm. So that's the key distinction that I would make between what's desirable and what's not desirable.
I think it has, and I think it's part and parcel of not thinking about who shareholders are. And there's a very famous person in corporate governance I call the good Adolf Berle, who predicted the rise of institutional investors. And he was concerned, actually, he believed that companies had become much more trustworthy in the post-World War II era because of the New Deal and European social democracy, and that companies operated within a consensus. And he actually thought that the separation of ownership and control actually had gone from being a potential weakness to a strength, because corporate managers operated within a strong societal consensus that channeled their behavior in the interest of the many. With the rise of the Reagan administration and a return to kind of 19th century approaches in the US came also as part and parcel of this focus solely on stockholders. And if you think about it, the power of stockholders with institutional investing has grown, and the power of other stakeholders, particularly workers, has gone down. And when you have that kind of shift, then you get a natural effect. I agree. The thing that I most fundamentally agree with them on is that we have to look at who human investors are. Human investors don't just own equity in one company, they own equity in a bunch of companies. But even more than that, they also own the debt of companies. They buy bonds. We don't have any focus on monitoring for debt. They're also the consumers. And when opioids hit their community or something, they pay taxes. When companies don't pay for their share of those taxes, they breathe air. And for most people, what they get to save for retirement depends on having access to a good job. So they need the system to work better. Where I'm skeptical is the institutional investors in the United States brought us the managed to the market policies. They demanded it. And so we really have to think about what their duties are, and we need to get corporations out of politics because they're acting on the rules of the game. We can't just act as if they're not, because in the United States, they are the biggest ones, and they're lobbying against the very regulations that are essential to protect workers. But I think the whole idea of Sir Oliver and Luigi to look at the full range of interest that human investors actually have and to make sure that our corporate governance system focuses on them is essential and brilliant.